So today we are going to go over in our webinar what to do with a year-end audit, and we have a very special guest with us, Mr. Vishnu Sharma. Now, my name is Ryan Allen. I've been with TOPS now for about 23 years. My background is actually in accounting. I took my CPA exam, and then I went to TOPS. I used my background to actually help build the application. Now at TOPS, we kind of look at community management a little differently. Let's go to the next slide here. Hold on one second. Okay. So at TOPS, we kind of look at things as a whole ecosystem. The base of the ecosystem is going to be your system of record. At TOPS 1 is our latest creation. It's a SaaS-based cloud database. It's full accounting. We also provide the financial services. Every community out there is going to have a need for financial services. The next piece of that puzzle is managing payments. Payments are going to be coming in, and payments are going to be going out. We've developed a couple very neat new technology around that. We think it's very handy. The next piece of this pyramid is going to be resident engagement. You have to be able to get a hold of your owners. You have to be able to communicate with them. You have to let them know what's going on. And they have to be able to do the same thing with you. And last are the vendors. A lot of times people don't think about the vendors and how they relate to the whole community. They're a very integral part, and they need to be included in this ecosystem. So that's a little bit on TOPS 1. Now we're going to introduce Vishnu with Sharma and Associates, and he's going to be going over some material for how to what you need for a year-end audit. Vishnu?
Hey, thanks so much, Ryan. I would make a terrible Vanna White not advancing the slides as I was supposed to on a timely basis. Sorry about that. So good afternoon, everyone. We're going to have a fascinating topic today of auditing, which is always a barn burner and a page turner. So just a little bit on my background. I've been a CPA now for a little while, practicing in the field of both audit and community association accounting for about 16 years. Prior to that, I was corporate retail, Bed Bath & Beyond, Sports Authority, etc., where I did internal, external theft programs for a number of years. I've had the opportunity to work both on the accounting side and the auditing side as a CPA, and that's given me a great perspective of being able to know what an auditor is looking for, and then also the challenges that an association has in trying to prepare that information and get that out to an auditor in a format that they need every single year. Whereas one association has one specific set of documents to get to an auditor in a given year could be handling 20, 30, 40 associations worth of audits in a season. And depending on the state that you're in, there may be deadlines, and we'll discuss all of that. I also have the opportunity to serve as the past immediate president for CAI Southeast Florida, and I'm also the chair of the Business Partner Council of CAI National. I'm also a member of the Board of Trustees and become the president-elect of CAI in January for the national organization. So really proud of CAI and the work that they do in bringing this industry together. Today we're going to be covering, I want to give you a little background in what an audit is. And when your auditor is asking you for things, I want to give you a little behind the scenes, behind the curtain, as it were, in understanding why they're asking you for what they're asking you, and why it's important to get certain things in certain formats. And you know, as an end user or as an association, you're looking at something in a particular way, and then you send it to your auditor, and they're like, no, I can't get it this way. It has to come directly from the attorney, or no, it has to come directly from the bank. And there's reasons for all of those things, and we're going to kind of cover that, and we're going to go through what in an audit they have 7 steps basically to an audit. And I'm going to kind of cover that in general for you as well, and I'm going to give you some tips that I think will help as you go through understanding, as we go through this process, understanding exactly what you want to be able to do and how you want to be able to present the information. We're going to start with just a little bit of background on the industry as a whole. CAI puts out, they have a research center, a foundation that prepares incredibly in-depth information about the industry, both at a national level and at a state level. What I've given you is 2 slides here to give you an idea of just how big this industry is. There are nearly 350,000 community associations in existence today. 50 years ago, there was barely 10. And that growth has just been continually expounding. 73 million people live in a community association. Basically 1 in every 4 in this country live in some form of a community association, whether a condo, an HOA, a co-op. 3,000 to 5,000 new community associations are formed each year. So it's a pretty significant part of the country as far as housing models go. When you look at the number of residents and you see that growth of, from 1970 to 2018 on this report, we're now topping 350,000 in communities. But the amount of money that moves through community associations is equally staggering. $95 billion in annual assessments pass through a community association. You're talking about a value in excess of $6 trillion for the value of homes that are involved. Everybody who's doing budgets right now, as I think everybody is, we all know what we're dealing with, at least in South Florida. Not sure the impact across the country, but in Florida, we're seeing 15, 20, 25% increases in our annual insurance premiums. And when you're a high-rise oceanfront condo and you're paying $200,000, $300,000, $400,000 in an insurance premium, and you get a 25% increase, that's $100,000 or more. It's pretty significant and dramatic hit to your budget. 30 to 40% of community associations are self-managed. 7,000 to 8,000 management companies in the US. And there is a regular polling that CAI does, just gauging the temperature of communities and the people who live within them and just how well they're enjoying life within a community association, which is a trade-off. You're giving up a certain level of independence for community living, but that community living gives you a shared opportunity of expense as well as an opportunity to reduce the cost of your living because you're sharing common area space with others. 87% of unit owners are happy in and with their community. Okay. Now let's get into the world of audits. Depending on where your state is, and obviously we're based in Florida, as am I. So I've given you some information on Florida here, but we have a couple questions, polling questions. Sandra, can we kick off those polling questions at this point? There's just a couple things I'd just like to get an idea of the audience today and understand. Polling must be closed to enable. Okay. Just seeing if I need to do something here. But just a couple things that we want to be able to get a gauge of who's actually listening. So there's 2 polls we're going to be doing. And the first one, are you Florida based? 67%, no, 33% yes. So 1 out of every 3 of you are Florida based, most of you are not. And then the other polling we're asking, which is now coming back in, is just understanding what the nature of your job is or role within the community association. And it looks to be overwhelmingly accounting and bookkeeping as the numbers are coming in. 68% have voted so far. About 2/3 of you are in the accounting and a quarter of you are in the management field. So great. Okay, gives me a good idea of who the target market is here today, or the audience. So I'm going to reference Florida, but these are going to be very general comments. And the call out is that within each of your states, there's a regulatory framework. So when you have to do an audit, is it required because it's in your declaration? Is it required because it's in statute? Is it required because it's in both, right? In the state of Florida, for example, it's required usually by both. Many declarations have a requirement that there's an annual audit review or compilation that's done. And then in the statute for condominium and homeowner associations in the state of Florida, we are required to have it. So we're required by both. We're required both by declaration and by statute in Florida. Everybody would need to just know in your individual state what the rules are as far as requiring that. Here's just an idea, there again, using Florida as a model. Florida not only by statute declares what you're supposed to do as far as year-end financials, they also define what you're supposed to do as far as the type of accounting method or principle that you're using. So not only do you have to be in accordance with GAAP, generally accepted accounting principles, but you must also use accrual accounting and you must use fund accounting. And those are two very unique methods of accounting. That's accounting we all live by, right? We all, if I get paid, I record in my checkbook. If I pay a bill, I record that in my checkbook. And whatever money I have in that checkbook is the amount of money that I have available to me, and that's cash accounting. Accrual accounting, and this is a challenge we have with a number of associations explaining the concept when somebody is from outside the state of Florida that comes in and they join a board and they don't understand why we have to present accounting the way we do. Accrual accounting says I'm no longer concerned with when the money hits my bank or leaves my bank. I'm concerned with when did I incur the expense and when was the money due to me. So we bill on a monthly basis. Most associations bill their owners on the first day of every month. Well, when you bill on the first day of every month, that's revenue to the association, right? Whether you collect that money 5 weeks down the road or you collect it 3 days, it doesn't matter. You record it as revenue once you bill that on the first of every month. Expense-wise, if I had a flood on Christmas Eve, December 24th, and I incurred $30,000 worth of expense for the restoration company, the plumbing company, etc., to do that, I may not pay that bill probably until January or February. I might not even get the invoice until then, but I have to accrue for that expense and record that expense against December so that expense shows up in the correct month. That's accrual accounting. Financial reporting, going back to requirements either within your statute or in your declaration, there may be a deadline as to when that reporting is due. In the state of Florida, for example, we're required to have the year-end financial, whether it's an audit review or compilation, must be prepared and available for owners within 120 days after the end of the fiscal year. It's a very tight window because when you think of it, what ends up happening is December 31st comes, you're closing out your books for the year, probably by the third week of January, best case scenario, fourth week of January, realistically. So you're now lost 1 month of that 4 month that you have to prepare your audit for. So if management or the association's closing out by the end of January, the auditor gets those financials. An audit will run, a full audit complete for an existing client will probably take realistically about 8 weeks, could take up to 12, depending on the complexity of the books. So that gives you no margin of error in trying to reach that 120 days. And it's not that it's going to take that many months to actually do all the work. The challenge becomes you've got the work to get done, but you're relying on other people. And it's in stages as we're going to see the way an audit's prepared. In the state of Florida, we have limits that define what level of service. We're going to talk mostly about audits today. I will touch on review and compilation at the end of the presentation, but we have a specific dollar amount that you're required to be able to have the amount of money that you're needing. If your annual budget's over $500,000, you're going to be required to have an audited financial statement. If it's between 300 and 500, a review, and between 150 and 300, it would be compiled financials. And what is the content of an audit, right? What should be in your audited financial statements? You're going to need to look back there again. GAAP is going to give you a guideline. So GAAP says what's supposed to be in there. But in addition to that, does your state require something unique or different than GAAP? So in the state of Florida, for example, there are specific supplemental schedules that are required that may not be required by GAAP for reporting. So you need to make sure that in addition to the standard balance sheet, statement of revenue and expenses, which is your income expense statement, your change in fund balance, your statement of cash flows, and then the notes of the financials, there's a supplementary schedule on reserves that's required, and there's one for income expenses that's usually included, where you're looking at your actual versus budget. Okay. Now going into the 7 steps that are part of the actual audit process. Pre-planning and knowledge. So before an auditor takes on, one of the first things you'll get if you reach out to an auditor and you say, hey, we'd like to get a proposal from you to be able to do our audit for next year, which, by the way, many associations have been doing over the last couple of months, because it's November now. You should be getting your audit engagement already signed and in place, because many audit firms will actually start doing due diligence in December and getting to know the client if it's the first time. If it's an existing client, maybe less so. You have to look at when an auditor gets that, the auditor is going to look at your client industry. So they're going to know, do I know this industry? So you want to make sure that when you're selecting an auditor, that your auditor is well versed in community associations. You don't want a not-for-profit. You don't want an audit firm that only does for-profit clients or does universities and schools and higher education. You want them to have a deep bench strength or knowledge in this industry, which is community association, which is so unique an industry because it takes different methods of accounting and puts them together. So there's schools of accounting thought, for-profit, not-for-profit, and governmental, that all kind of get mashed together and becomes what we call CIRA accounting, which is the basis for condo accounting or community association accounting. Understanding your structure as an organization, your association, are you a multi-condo? Do you have for-profit entities that are part of it? Are you a golf course? Are you a community association where you have a clubhouse? Are you a high-rise where you have roof antenna income because you've rented out part of the roof to cable companies and you're collecting revenue from that? So those are all things that you meet that the auditor needs to understand. They'll always ask you for a copy of your prior audit, and then they'll ask you for a copy of your most recent financial statements so they can get an understanding of who you are and how your organization is made up. Contracting for an audit, what you get is called an engagement letter. That engagement letter is pretty much format dictated or prescribed within the guidelines of the AICPA, the Association for CPAs. That's the national organization that we all belong to. It's created by us and it's sent to the client, and it's a clear understanding of what we're going to do, what we expect from the client, and then it's signed by usually the president and or the treasurer of the organization. Some CPA firms will ask for the management company, if there's an independent management company, to sign off on it as well. Not required, but sometimes it's requested. Obtaining an understanding of internal control structures. This is really the core of where we start. One of the first thing when you get that laundry list from the auditor, and the auditor sends you, and it's usually 30 items, 40 items on that list. And what they're really looking for at this point is they're trying to be able to understand what's been going on for the last year for you, and look at all the transactions. And in doing that, when they do that, they're going to send you a questionnaire because they want to understand, how are you processing your AR? How are you processing your invoices through checks? How are you processing your unit owner payments through the deposit into the bank? Who's doing the bank reconciliation process? Because what they're looking for is, do you have segregation of duty? Do you have somebody who does AR that's separate from accounts payable, that's separate from bank reconciliations, that's separate from financials? Or do you have one person that's doing all of that? Because the difference would be, an auditor has to assess, and we're going to cover that next, is risk. And one of the keys in assessing risk is you have to be able to understand what level of risk to assign to a particular association or a particular audit. And in doing that, that's going to dictate the amount of work that needs to get done. How many transactions do I test? How many areas do I need to look at within that association's accounting records to be able to get a good opinion of the health of that organization? So the understanding of the internal control, the most fundamental entry point for what we're going to be doing. So when you get that questionnaire, so here's a helpful end. Normally you'll get that questionnaire, it might be in a PDF. Ask for it in a Word document. Fill out that questionnaire, save it as a Word document. more than likely it's going to be the same questions every year. They may tweak something one or the other, but it's going to be essentially the same thing. So hold on to it, save it, because next year when they ask you the same thing, just modify whatever you did last year, update it, review it, make sure it's what you need, and it accurately represents what you're doing as far as processes. But there's no need to recreate that document for yourself every single year. Just keep it as a Word document, save it, modify it as needed, and make sure it completely accurately represents what you're doing.
So a good system of checks and balances is something that you look for in an accounting company.
Absolutely. Checks and balances are probably one of the most essential things, Ryan. Great question. Because within our firm, for example, we're large enough where we have the opportunity to have AR as a separate department, accounts payable as a separate department. We have bank reconciliations as a separate group, and we have monthly financial preparation as a separate group. That's the best case scenario, because you have no one person who controls everything. If you're in a situation where I've gone into associations where we have one person, that's the bookkeeper. They're the person who takes the unit owner payments in, they write the checks for the association, they reconcile the bank statements, and they prepare the monthly financials. That's probably the least enviable situation for an association to be in, where you have one person who controls everything, because there's no segregation of duties. There's no internal control in that process or environment. What you're going to be relying on is that the board member who is actually signing that check, and hopefully it is the board who is signing that check, is going to be the person who's going to try to catch something. But there again, if something's going on in there, it'll be very hard to identify, because one person controls the entire process. So they're able to do what they do on the AP or the AR side, and then they're able to mask that through the bank reconciliation and then creating the financials. So yeah, segregation of duty, internal controls, synonymous. Assessing the control risk. This is the basis for the audit. Once we've gotten the internal controls and we understand what the internal control situation is within an association, we then are going to decide, are you low, medium, or high risk? And depending on whether we dictate that you're low, medium, or high risk, we're then going to turn around, then it's going to guide how much auditing procedures we're going to have to perform. So if you're deemed to be low risk because you've been my client for 5 years, you've got stable management that's been in place for 5 years, the board's been in place for the last 3 years, there's no major swings in your actual variances on your numbers year over year, you may be a low risk, right? If you've had 3 management changes in the last 4 years, if you're on your second board in 2 years, if I look and see great variances in specific line items year over year in your expenses, you're going to be a moderate to a high risk. And there's going to be some other factors that'll play into that to determine that. If you're moderate to high risk, then instead of testing 1 in every 10 transactions, I might test 2 in every 10 transactions or 3 in every 10 transactions. So sometimes we get the question, it's like, well, wait, you guys did our audit last year. Why is it, more than what it was last year? Why do you need more information? Well, because you've actually changed boards and you've changed management. And when you changed management, your data didn't carry over. We have a gap, right? So the one management company left in April 30th and the next one started in May 1st. And we have to look now at the cutoff of that transaction and the transition between the two, because when we do an audit, if I've done the prior year audit, I'm looking at your prior year audit and saying, okay, I did your audit, I know what my ending balances are. The first thing I'm doing is I'm looking at your audit in your financials, and did you post my entries? Because every audit is going to give you, for the most part, adjusting entries to post. Did you post the entries I gave you, right? Have you adjusted your books to match the audit? If you haven't, now you've incurred additional, or I've incurred additional steps, because now I have to reconcile your books that are not up to date with my audit from the prior year to my audit, right? So that's my first challenge that I'm going to face. If your books come across and you've posted all my adjusting entries, okay, I'm good. If there's a change in accounting, because you've decided to change from the pooling method of reserve to the line item method of reserve. Well, now I've got to go look at your balances and I've got to do additional calculations to make sure, did you do that transaction correctly? Did you get the right necessary votes that are required by statute, and to separate out the changing of the method and the moving of that pooling? So every time you do something, did you pass a special assessment this year? Right? Did you go through? I'm going to look at the board minutes and make sure that you've passed you've done what you're supposed to do by statute. In approving that. Are you then spending your expenses according to that? In other words, was your special assessment for a roof project and you've taken some of that money and you've actually now used it because you had an emergency paving repair and you had no other source of funds, so you borrowed the money from the special assessment? We get that often, but you can't borrow obviously from a special assessment. So that's now going to require additional work for us to be able to do, because we're going to have to now tie out those numbers, identify what was incorrectly spent from that fund, whether the reserve fund, whether the special assessment fund, etc. And we're now going to have to we're going to have to identify that, separate that out from the special assessment, separate that out into the operating, and our books are now going to be markedly different from what you gave us, because we're making those adjustments to correct your books to what you should have done, right? And then there's going to be a note, usually after the audit is complete. The auditor is going to give you a letter, and that letter is going to be something that's going to speak about your internal controls, and we're going to call out certain things. You have more than $250,000 in a particular bank account or in a banking relationship, which is in excess of FDIC insured amounts. So we're going to call that out. It's up to you how you and the association choose to address it, but we're going to call it out. If we see that you've used reserve funds for something that they shouldn't have been used, we're going to call that out as well, right? If you're using special assessment funds in the same way, we're going to call that out as well, okay? So you're assessing control risk, super important. It dictates how much work needs to get done. We have a base amount that's going to be done. The question is, do I need to do more than that base amount? Because everybody walks in with a certain base amount of risk, and we may be able to increase or decrease certain sections of that depending, but there's a base amount that's required to be done no matter what. Substantive tests. So now this is the heart of the audit. This is where you're going to get that initial email dump request that you get from us, and that's going to say, look, we need your trial balance, we need your general ledger detail for the last year, we need your quarterly payroll tax reports and returns. And I'm sure you're all cringing because you know these requests by heart by now, for those of you in the accounting and the bookkeeping side. We're going to ask for all your board minutes, we're going to ask for contracts, all of these things. I would strongly recommend that during the year, if you just compartmentalize, we have associations that have all this stuff, like all the contracts are in one place. So when it comes down to the end of the year, most CPA firms will give you a Dropbox, and you can just load everything into the Dropbox. On our side, for example, on the accounting side of the firm, we have all AP is booked in this particular folder. So at year end, for those 85 or so associations where we do the day-to-day bookkeeping and accounting for, we simply just upload all of that AP into a folder. If you're using specific software and you can grant them the opportunity to be able to access the software, probably the best case scenario. TOPS 1, for example, you can create a read-only access for your auditor. Spend 30 minutes, show them the basics of how to do it if they don't already know how to use it, and then turn them over. They can run their own general ledger, they can run their own trial balance, they can look up their unit owner ledgers, because they have to look up unit owner ledgers for histories. They can export documents to Excel, which every auditor wants, because if I can export a document to Excel, I can work it. Right? I can sort it. I can do my variance checks on it. I can do my VLOOKUPs. Whatever I need to do, I can do it in Excel. So if you have an accounting program like TOPS 1, you're able to go ahead and export that data. Or even easier, just give them control. Just give them read-only access. They can't change anything to it. Spend a few minutes with them, teach them how to use it. Let them go at it. We have certain management companies we work with where they have their own proprietary software and they just give us access to it. When they give us access to it, we're able to go ahead and go in and get what we need for the most part. That takes a tremendous amount of burden off of the association. So you definitely want to be looking at that, because if you can do that, you've probably just saved yourself half of the amount of time that it's going to take for you to pull data together and give it to them. Okay.
So in this day and age, you're using virtual documents instead of actually paper documents most of the time.
Correct. Great point. Yeah, audits have become virtual for the most part. Yeah, everything is uploaded to Dropboxes now. You still may have an auditor that will go out on site, but for the most part, it's all virtual. It's everything is verified, validated. Substantive tests are done through document requests that are provided virtually. Either we get to go into the system, which is great because we actually can get our own document from the source, which is the accounting system itself, or the association will send it directly to us. Right? And substantive tests, we're looking at two specific things. We're testing from your general ledger, your accounting system, down to the actual document, source document. So if you have an expense under repair and maintenance for $5,000 to Bob's Plumbing, we're going to check and make sure that if you have an invoice in there, that you have a transaction for $5,000 to Bob's Plumbing on March 9th, we're going to then check the bank account. We're going to then check the invoice and make sure that that runs all the way through and it's a legitimate transaction. By the same token, we're going to go the other way, where we start with an invoice and we're going to look at that invoice and we're going to make sure that invoice clears the bank and is actually posted to the accounting system, that the vendor is the same vendor, the dates are the same dates, and the amount is the same amount, right? So you're going to have substantive testing working both ways. Analytical procedures that we perform, procedures would be what percentage, for example, is electric to your total bill this year versus what was it last year, and are there any variances? You'll get that, you'll usually get an inquiry from your auditor where they're going to say, listen, can you explain the variance for these 5 or 10 different line items? And it'll say that last year electric was 3% of your budget, this year it's 6% of the budget. Why is there such a significant increase? Or you're going to see payroll is decreased by $100,000, contract services is increased by $100,000, and they'll usually give you a specific line item within those categories. All the auditor is looking for you to explain is why, right? They're just looking for why. Well, the association decided to outsource security. So we no longer have payroll for security. We've outsourced that to a third-party vendor. The vendor is Bob's security guard services. Then the auditor can go in, take a look at Bob's security guard services in vendor history. They can see that Bob started in August and that your payroll for that ended in July. Great. They can now tie that out and substantiate the information you provided them, right? So those are the types of testing that's going on behind the scenes when they're asking you, for all this documentation. It's very detailed. It's tremendous amount of transactional level work that they're doing to tie things back. And they're having to go back 9 months, 12 months into last year to try to tie out these transactions for you. Evaluating the evidence. So once they've gathered all this information and documentation, they're then going to have to go through and look at all of the information they've gathered. And when they do that, that's when you're going to get the second round or the third round, where you've provided them all this information. They're going to come back and say, okay, great, thanks for all of this. Can you give me the ledgers for the following 5 units? Can you give me these specific invoices? Can you please explain this transaction? Or can we get a copy of the contract for Nextel for the antenna that you have on the roof? Whatever it is. That's going to be the second level stuff, where they've gone through all the information you provided, they've evaluated the information you provided, and they're asking you for some additional information because they need greater clarity on a particular topic. So now if you started from the full funnel, you're narrowing that down just about towards the end, where they've gone through the bulk of the information you've given them, and they've now gotten down to 5, 10 tangible things that they need to tie out to reconcile this. One of the things that they're looking at, and we had to do this for the first time in a very long time this year, where we had to issue an audit where we declined to offer an opinion because the information that we asked for was that it was a new audit client. We asked for the information and we didn't get it. We didn't get all of it. So they didn't provide us with the general ledger. There was gaps in the general ledger. There were invoices that we asked for. We couldn't get invoices to support. If you can't provide the auditor with all the documentation that they have requested, you run the risk of one of two things happening. If the auditor can get a comfort for everything else that's in there, except for that limited document that you can't provide, then they're going to give you what's called a scope limitation, which means we've audited the books, and except for this one thing, the contract for the rental agreement for the roof antenna agreement, or the invoices related to Bob's Guard Company, which we didn't get all the invoices we requested. Everything else looks good except for that. So I can't offer a clean opinion on this audit. I can accept a limited scope opinion, right? Because I have a scope limitation. I don't have all the information I needed. Or worst case scenario, you did what we did, you get what we had to do earlier this year, where you just declined to offer an opinion. There are so many things that we did not get that after 6 months, we're done. I have to issue no opinion on your audit. Here's your financials. I will give you the audit the way we prepared it, but I didn't get the information I needed to validate the numbers that are presented in here, right? Never want to be on the other side of one of those. Finally, the audit report. So the audit report, when you get the audit, and I kind of alluded to this in the last slide, your audit report is technically, everybody thinks of the entire audit as the audit report, but it isn't. The audit report is technically just the 2 pages or 3 pages in which we give our opinion. And of the audit, review, and compilation, the only financial statement we actually will give you an opinion on is an audit. We do not offer an opinion on a review or a compilation, and we'll talk about those in the next couple slides. But in the audit report, we can offer an unqualified opinion, which is what you would want. Unqualified means I have no issues with anything in that I've seen in here, in that I've received all the information or sufficient information for me to be able to form an opinion on the financial statements, and that opinion is a clean opinion. It's unqualified. I am not qualifying it. I'm not saying there's a limitation. I'm not saying there's a reason, there's an emphasis of matter even. I'm saying it's unqualified, right? The introductory paragraph sets forth the entirety. And actually, if you look at your audit from this year and you look at your audit next year, they're actually changing the opinion letter. So, it's always the tail that's wagged by the dog, and your auditor is the tail. So we have many masters in the world of audit. As we mentioned, the declaration of the association, the state statutes, the state administrative code, and then GAAP, right? Generally accepted. All of those dictate how we have to perform an audit, and all of those dictate the format in which it's presented, right? So what you're going to notice is the audit report, or that audit letter that gives our opinion, is changing, and it's going to look different starting next year, where the opinion is now at the beginning of the report. Their opinion used to be usually on the top of the second page or the bottom of the first page, depending on how it's formatted. But now it's going to be the first thing you're going to see. You're going to see the level of opinion that came out, and then the rest of the information is going to be there below it. A qualified adverse disclaimer we kind of talked about, but an adverse opinion, a qualified opinion means they're just levels by which the auditor is saying, look, we can't offer a clean opinion. We can't offer an unqualified opinion. There were problems with this. We either had a disagreement with management. So for example, you may be able to have an audit that's done, but management, the board, chooses to present information in a certain way. One of the things that's come up over the last number of years is an association would do a special assessment. When they do a special assessment, if they spend the money, I don't want to get too technical on this, but if you spend the money in advance, you borrow the money from the bank, and then you do the work, and then you get the payment from the owners over a longer period of time. Associations would book the expenses as a prepaid asset, right, or a deferred asset. Well, you can't have a deferred asset. GAAP's made it clear that that's not an allowable treatment of that. You actually have to recognize that expense. But you have associations that will do that if they disagree as to changing that. When we get ready to do the audit, we'll still issue the audit, we'll still issue our opinion, and our opinion may be good, but it may be qualified, because we're going to say that, listen, the association has chosen to present these financials with this non-GAAP method of accounting because it serves their purpose, but we're going to call it out in the beginning of that report, right? Review. Ryan, if there are any questions at any point, just chime in, let me know. And if anybody has any questions as we're going through, you have to wait for Q&A at the end. You can, at this point, you can just throw it in the chat and Ryan will pick it up and let me know. So we talked about a review. This entire thing has been about a review, an audit, sorry, so far, explaining what an audit is and understanding that when the auditor is requesting documentation from you, you should be, at this particular point, by December, you should be trying to gather your stuff together because you know what's coming. Because if you have an audit done every single year, or a review, or even a compilation, you know there's going to be those requests that's going to come through. Your board minutes, that should be in a separate folder all ready to go. Your invoices and your AP, if you use a third-party software, great. If you don't and you're doing it in-house, it should be in a particular folder, and there should be some rhyming, to that. If you're still having paper copies of everything, it's 2022. Gotta get to putting everything digital. You should be scanning that stuff on a weekly basis, saving that stuff, and saving it to the cloud. If you book it on, if you save it onto your hard drive on your server, great, but you need to be backing up a copy as well. And that's another thing as part of internal controls is, are you backing up? Is there some level of redundancy of the information that you're saving? Because one of the things that we see out there are where management leaves, new management comes in, and there's a loss of documentation. And the new management and the association says, well, we can't have it. We don't have it because it wasn't given to us. Cannot help you when it comes to the world of audit. You either have it or you don't. And if you don't have that information to provide, you're going to get a scope limitation. And if there's enough of it that's missing, it's going to be beyond a scope limitation. It's going to be a no opinion. We'll issue the audit. You'll have a starting point for next year, but you'll get a no opinion. Now, a review differs substantially from an audit. In an audit, we're doing two very important things. We're actually testing transactions from your system. So we're actually, like I said, we're looking at invoices, we're looking at bank reconciliations, we're looking at the general ledger, and we're testing to make sure that we're seeing that flow through all three of those parts of the financial system, right? We're also doing independent inquiries. We're reaching out to your attorney through you to get independent confirmation of litigation. We're also trying to get independent confirmation from the banks to make sure that the financial statements or the bank statements you provided us are tying out to what the bank has on record, right? So those things are done at an audit level. Our review is lesser in scope. There is no audit. There is no audit. There is no opinion that's offered. It's a limited assurance that we're offering, that we're seeing no material misstatement in preparing a review. We're doing two things in a review. That's it. We're doing analytical procedures where we're running Excel, basically, analyses that are looking at year-over-year variances Or within a given year, what's your percentage of an actual income or expense line to your total? Or what is it year over year? And we're going to send you those, any variances we see, and we're going to ask you to respond. That's your analytical procedures we're doing. Inquiries will be where we're going to ask you to explain any variances. And then there'll be other procedures we may do depending on some of the information we sent. But essentially, it's going to be inquiries of management to understand what's going on, and we're going to have analytical procedures. That's it. We're not reviewing internal controls. We're not assessing a risk of fraud, and we're not doing the actual testing of your accounting records. And that's so important for people to understand, because certain states have the ability that if you are required by statute to have an audit, they allow that a majority of owners can go ahead and step down and vote to have a review. That should never happen. If you're required to have an audit, every association that's required to have an audit should have an audit. Because, and you look at the cost of an audit compared to if it's 5, 10, 15,000, whatever that number is, compared to a $1, $2, $3 million annual budget or more for the association, it's an immaterial cost to make sure that somebody independent of the association of management is reviewing your books on an annual basis to make sure that they're understanding it. A compilation, if a review is substantially less than an audit, compilation is really just an accounting record and nothing more. A CPA is not required to be independent under GAAP for a compilation, at least in the state of Florida, which means that a compilation, so if a review, if an audit is an opinion, a review, at least we're saying that we're not seeing a substantial material difference. In a compilation, we're not offering anything. If you ever read a compilation letter that you get at the front of your compilation, it basically says that we're disavowing everything. The information is, we're taking the information provided by the association and putting it into GAAP and or statutory format. That's all we're doing, right? We're not testing anything. We're not inquiring about anything. We're not running any analytical procedures whatsoever. So for a community association of any kind to get a compilation done, whether required by statute or not, to me, the minimum, my opinion only, would be a review. To have a compilation done is simply taking whatever management or the association has prepared and simply put it into a format and issued it with notes to the financial statement. That's it, right? And when you look at your financial statement, your audit, your review, or your compilation, you're going to get your opinion letter or the compilation letter or the review letter that'll be first. Then you're going to get a balance sheet, your income expense statement for the most part, your cash flow. And then you're going to get a bunch of notes. And the notes explain the balance sheet. The purpose of the notes are to explain the balance sheet and the income statement. Are there unique transactions on there that need to be explained? They'll usually include something about the reserves. They'll include your basic comments about what a prepaid expense is, what an account payable is, what an accrued expense is. And it really just explains what you're looking at in the financial statements. If there's something that the association needs somebody to know, we borrowed money from a bank this year for whatever purpose, and here are the terms. We passed a special assessment, we're collecting it over this period of time, and this is how much it's for, and this is how we're collecting it from the owners. That goes in there as well. If you have litigation, that's going to be explained in the notes as well, right? So that's the three major sections of it. You have the report itself, which is the letter at the front. You have the financial, which are the numbers basically, and that's usually 3 pages, the balance sheet, the income statement, and the cash flow. And then you have the notes. Now you may have supplemental schedules, which is a reserve life schedule, right? What are the components for your reserves? How much life do they have in total? How much is left? And what's it going to take to fund them fully for the next year? Right? That's a required element of it. And if you don't have it, your report or your letter at the beginning will tell you that there's an omission, that the association's chosen to omit this information, which is required under GAAP. Right? I just want to briefly touch on tax return. So community associations have a very special category for filing. So IRS Section 528 is required, not required, it's an option. You have the ability as a community association to file under either Section 528, which would be a Form 1120H, or you could file as a regular corporation as an 1120. Your choice, and you can change that election every single year just by filing. You don't need to do anything special. You can just go ahead and file, whatever it is. Normally, most associations, overwhelmingly, just a basic condo HOA is going to file as 1120H. And then what makes 1120H special is that all the money that you're going to get from your owners in fees and dues, that is strictly exempt income. So you're not, it's considered non-taxable. So you're not required to go ahead and do anything, pay any taxes on that. You're simply reporting it. You're only required to pay taxes on what is considered money that's earned. Interest earned on a bank, you have an antenna on the roof and you're renting it out. That's rental income, right? So those types of things you're required to pay taxes on. It's usually a flat tax if you file as an 1120H. And whoever your auditor or CPA is that's doing your audit review or compilation always usually does the tax return, because your financials are not complete until your audit review compilation's done, right? So your final numbers to file for taxes aren't done. That's why usually your engagement for your audit review compilation also includes your engagement to do your tax return, right? And if you're doing 1120H, pretty straightforward. Once you decide what's actually taxable income, you're allowed to deduct any expense that was incurred in earning that money, right? So if you have laundry income because you people pay to go ahead and use the laundry machines in the building, well, you have water, you have sewer, you have management fees in related to managing those, you have repair costs for it. Those things can all be written off against the income earned. And if there's anything left over, that would then become taxable. And I think that brings us to the end. So Ryan, if we have any questions, I'm happy to take any questions. I think we're pretty close to wrapping up here.
Actually, we don't really have that many.
Okay.
I think you've covered very well, very extensively from start to finish, including the taxes and everything.
Great.
So let's go ahead and just go ahead and wrap up and see if there's any questions that come in here. So if anybody has any questions, please send them in now. We'll kind of hang out and wait to see if those come in.
Okay, great.
Hi, Ryan. This is Sandra, and hi, Vishnu. This was a really great session. I did have a couple questions that were coming through Q&A.
Okay.
First being, could you repeat the statement about the gap rule you'd mentioned earlier?
Not sure. So, not sure which exactly. So gap requires, gap dictates when an audit is performed, how an audit has to be performed. And there are supplemental schedules for an audit that are required under gap. So for example, a state may not require a reserve life schedule. gap requires a reserve life schedule. So you want to make sure that you are not only looking at what your state requires, your declaration requires, you also have to pay attention to what gap requires.
Great, thank you so much. And there was another one. If I have an association with annual revenue less than 150K, and their documents state that an annual audit is required, is the association required to have an annual audit performed? And that's from Jonathan Peterson. Thank you.
Okay, so two things. One, your declaration rules. General rule, and I will always defer interpretation of a declaration to legal counsel. So let me say that right up front, not offering legal advice outside of my scope. Generally speaking, however, if there is a conflict between statute and your declaration, the higher standard will usually prevail. So statute, and I'll speak to Florida specifically, statute is seen as being your base. Your declaration can go higher than that or can exceed that limit. So for example, if statute in the state of Florida is your special assessment notice or your annual budget meeting notice has to be 14 days mailed prior to the meeting, I have associations that have 30-day notice requirements. Well, if that's in your declaration, you must follow a 30-day notice. You cannot default to the state if your declaration specifically for your association calls out. So if in the case of that association, even though they're less than 150,000, which would not even be a compilation by statute, if you're required in your declaration to have an audit, then you're required to have an audit.
No, I think that's just as a reminder, is a housekeeping note for everyone that's still on. We will provide a copy of the recording along with the deck. So if we haven't answered your question here, we'll definitely get around to it. Thank you so much, Vishnu.
Okay, great. Okay, great. So I think, Ryan, I think we're done. It's 4 o'clock.
Okay, we'll wrap up, everybody. Thank you for your time and enjoy your afternoon.
Thanks so much. Have a great evening.